Welcome back to our channel, where we bring clarity to the world of finance. If you're joining us for the first time, remember to subscribe and hit the notification bell to stay abreast of our latest insights. Today, we delve into the investment strategy of an undeniable titan of finance, Mr. Warren Buffett. From humble beginnings to steering the helm of Berkshire Hathaway, his journey offers valuable insights for investors around the globe. Ready to dive deep into this fascinating world? Let's get started. Who is Warren Buffett? Warren Buffett, often referred to as the Oracle of Omaha, is the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company. His name is synonymous with success in investing, and his net worth, well into the billions, is a testament to his prowess. But Buffett didn't start as a billionaire. Born in Omaha, Nebraska, during the Great Depression, he bought his first stock at the tender age of 11 and has been building his empire ever since. So, what's the secret sauce behind Buffett's success? It's his unique investment strategy, heavily influenced by the principles of value investing. The roots of Buffett's strategy: value investing. Value investing is a strategy that was conceived by Benjamin Graham and David Dodd, professors at Columbia Business School. It's no coincidence that Buffett. He later worked for Graham's investment partnership, further solidifying his belief in value investing. But what exactly is value investing? In simple terms, it's about finding and buying stocks that appear to be underpriced compared to their intrinsic or true value. The goal is to discover these hidden gems, invest in them, and hold on to them for an extended period, ideally forever. This long-term focus sets value investing apart from other strategies that prioritize quick gains. Buffett's approach to value investing involves several key principles that he has refined over the years. Understand the business. Buffett emphasizes the importance of knowing the business you're investing in. It should be simple, predictable, and stable over the long term. If you don't understand it, stay away. Long-term economic moat. Buffett borrows the term moat from medieval castles. Just as a moat protects a castle from invaders, an economic moat protects a company's long-term profits and market share from competitors. Management quality. Buffett also looks for companies led by competent, honest, and dedicated managers. He prefers leaders who are passionate about their work, rather than those driven solely by money. Margin of safety. Buffett ensures he buys companies at a price far below their intrinsic value, giving a margin of safety. This approach provides room for errors, bad luck, or unforeseen events. Buffett's strategy in action. Over the years, Buffett has applied these principles to build Berkshire Hathaway's impressive portfolio. Let's look at some real-life examples. Coca-Cola is one of Buffett's most successful investments. He recognized the brand's worldwide recognition and customer loyalty as significant moats. Plus, when he bought the stock in 1988, it was undervalued. Today, it continues to be a cornerstone of Berkshire Hathaway's portfolio. Another example is Buffett's investment in GICO. He recognized the company's unique competitive advantage: direct selling of insurance, cutting out the middleman, and passing savings to customers. He understood the business, saw its long-term potential, and believed in the management. And when he bought it, the company was undervalued. Applying Buffett's strategy to your own investing. So, how can you use Buffett's strategy in your own investing journey? Start with thorough research. Make sure you understand the company you're investing in. Look at its long-term prospects, the quality of its management, and the price you're paying for the stock. Patience is crucial. Remember, investing isn't about getting rich quick. It's about building wealth over time. Common misconceptions about Buffett's strategy. Buffett's strategy is often misunderstood. Some people believe that he invests in any cheap stock. But as we've seen, Buffett looks for quality businesses that are undervalued, not just any cheap stock. He also doesn't believe in diversification. Instead, he prefers to invest a significant amount in a few companies he thoroughly understands and believes in. And there you have it. That's our comprehensive breakdown of Warren Buffett's investment strategy. Remember to like this video if you found it informative and share it with your friends who are interested in investing. Don't forget to subscribe and hit the bell icon to stay updated with our latest videos.